Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers we have, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes which increase or decrease in importance over time. This week, we'll just run through a quick couple of themes actually that we've noticed we think are quite relevant at the moment. We'll then look at equities and the technicals on the major US indices. Ahead of then a quick review of last week's main events, some big events there, of course, with the ECB meeting, Eurozone inflation, and of course the FOMC meeting. We'll then wrap up with a big preview of obviously the main events this week, today's US CPI data, of course, and then we get the Bank of England meeting tomorrow. We'll look at the associated currency majors as well, so sterling against the dollar to do with the Bank of England meeting, of course, and we'll look at the DXY index, euro dollar, obviously to do with ECB and Eurozone inflation, and hopefully we'll have a quick look at gold as well, which may be affected, of course, by the US CPI data. Okay, firstly, we always start actually with this year-to-date charts, bar charts, which on the left-hand side is from a few weeks ago, last time we spoke to you, and the right-hand side is only a few minutes ago. We could just see briefly sterling coming to the top of the majors charts for this year. So this is year-to-date performance against the dollar. So cable effectively, sterling against the dollar. You can see quite decent gains actually over the last few weeks as sterling has broken 126, well 125, 124.47 was the key level we'll look at, then through 125 and 126 at the moment, currently at around 126.24. So interesting there. European currencies, of course, still excuse me, still top of the majors really because of their central banks being still relatively hawkish against obviously the Fed, against some of the other major central banks. We can just see there yen is still languishing, that safe haven bid for over the last sort of month or so after the banking crisis. Really that's sort of slowed up now, so there's been more selling in the yen, and especially as some of the commodity currencies are doing slightly better, potentially not pausing in their rate hike cycle. The RBA, for example, loonie as well, the Canadian dollar, slightly gaining on that better employment data last Friday when we had the non-farm payroll, which some of you might have missed, but just reining in there that we've seen of Bank of Canada cuts potentially further out because of that strong employment report. Okay, just at the moment this week then, marginal losses really in equities, kind of muted start to the week. All eyes on US CPI data, of course, later in a couple of hours or so. And then we also had UK markets closing on Monday because of the bank holiday. So kind of muted flows, news flow as well, quite limited. All the focus really is on that US fiscal drama, if you like. Treasury Secretary Yellen warned over the weekend the saga could bring economic catastrophe, I think she used the words, but the impact over the US debt ceiling increase is emerging slightly as an increasingly short-term supporting factor for the dollar, probably. Yesterday's meeting between President Biden and Congress Republicans didn't really yield much progress on a potential agreement. While leader Mitch McConnell, he dismissed the risk of a US default, but he admitted that negotiations were at a stalemate. We kind of think for now a short-term debt limit extension, which would be the quickest solution, that's been ruled out, and there is going to be a lot of noise around this impasse, around the drama, if you like. We always get this drama, it always ramps up, and it kind of has to get very bad for it to be then resolved and heads knocked together, if you like. Some support experts, I think, have kind of just settled on that situation. I think potentially as we get worse and the noise increases, then that could slightly weigh on risk sentiment and then offer sort of further support to the dollar. I know that some economists are saying that there is a growing concern that it might actually take a sort of market sell-off, either in equities or in, say, money markets and bond yields coming down to break the impasse. That's one school of thought. We kind of tend to think here that we'll just get a lot of noise and just slight movement in market pricing potentially. That's the thoughts at the moment anyway. Of course, as I say, the dollar might get a in the near term, or at least an underpin support whilst this goes on. And we also need to consider actually that dollar speculative shorts have actually risen steadily in the past few months, so they could sort of, the speculative shorts could just take back their positions, close out those short positions, and that help support for the dollar as well. Just onto those themes then that I mentioned. First one really is the sort of something must give one, I guess, is a theme, if that makes sense. It's really one of two opposing views. And I've got this chart in here just showing where we are now with the Fed and what happened post the last week's meeting versus the previous couple of months ago, March testimony as well. And the opposing views, well, we know now that corporate America is in a much better shape than many had thought, essentially as the US consumer is far more robust at the moment. And we've also seen the jobs market, NFP remains very healthy really, but we also remember and remind ourselves that it is a lagging indicator. Obviously, Chair Powell, he stressed it would take some time for inflation to return to a 2% target and dismissed hopes that interest rate cuts could be on the horizon. We'll get into that in more depth shortly. Just on this theme, then the other side of the coin is that bond markets are betting the Fed will pause. So not just pause, but cut rates very, very soon. And the divergent views have been growing for some time, but really they will, you think, come to a head as the gap is the widest it has been since last week's rate hike by the Fed. That's because from now then until January, Fed funds futures, they price nearly 5 25 basis point rate cuts over the next 6 Fed meetings. And we kind of think critical to the idea then is that inflation will come down quickly, and that has been hastened, of course, by banking sector stress. There are obviously other measures to measure that kind of impact. The deeply inverted yield curve is still happening. ISM surveys, so manufacturing surveys, point to recession, while of course commodity prices have been falling, suggesting a lack of global demand. So just really an interesting conundrum for us, for them really, for markets again having to resolve. If you remember, even a few months ago, we had this again where markets were thinking one thing, the Fed especially thinking another, thinking there wouldn't be any rate cuts, and the market eventually came back to the Fed's way of thinking, and the terminal rate, the Fed funds peak rate, if you like, if you remember, sort of was looking as though it could have been above 5.5 towards 6%. Some economists were talking about. So the market veered towards, if you like, the Fed's point of view, but then obviously we had the banking crisis and this big shift in rate cut expectations. And you can just see here then what's happened since last week, and really 5% being the peak in rates. We're coming down to below 4%, so that's nearly 5 25 basis point rate cuts into the start of next year. The other theme we just wanted to talk about was, just bear with me 1 second, sorry, I just want to pull up my charts that I don't have at the moment. So sorry, bear with me 1 second. Using Trading View, I guess many of you will probably use this kind of charting package as well. Sorry, I just didn't have my charts up. So yeah, the other thing we wanted to talk about was equities. Probably highlighted this quite a few weeks ago. It's been an enduring theme, really, and it's this idea of breadth in the stock markets in the US. So it's the idea that there's a small number of tech companies which are really driving an ever-increasing share of the US stock market gains, and that's prompted concerns about among investors about the sustainability of the rally that we've seen, especially this year. Goldman Sachs, they've jumped on this theme actually, so they've noted too that saying that big tech, so that's Apple, Amazon, Google, Alphabet, of course, Meta, Microsoft, those 5 companies collectively, they've risen 29% or so, and outperformed the S&P 500, the wider benchmark index, by 23%. In fact, Goldman go on to say these stocks are expensive when compared to the rest of the S&P 500, trading at a PE of 25 times. So that's near a 50% premium versus its other index peers. So the question, of course, then is that premium justified? I think we've said in the past that big tech has benefited, of course, from the Fed nearing the end of its interest rate rises. There's also been a belief that the sector would be insulated from this potential slowdown we're seeing in the months ahead. And then, of course, there's been this general enthusiasm over generative AI, artificial intelligence, of course. I think positioning is also an important thing, so that's played a big part as long-only big hedge funds are rebuilding their positions after selling big amounts of tech stocks last year when we had the big sell-off. So going forward, what happens? Goldman Sachs basically warning if the economy improves and rates increase, actually, then outperformance may slow. That's kind of where Fed officials are at the moment, talking about no rate cuts anyway, but potentially rates being higher for longer. So that may harm these big tech names. But then, if there is a recession, these stocks could be vulnerable as they are popular in some of those big hedge fund portfolios. So just again, a theme to highlight, we think quite important for stock markets. And price direction going forward. As for technicals, you can see we have the S&P 500, the weekly chart here. And we can see really we've actually still got this halfway point of the decline from 2022. So the midway point, 50% marker, is at 4155, and we really struggled to close. Above there in any meaningful way. You can see we sort of tapped it a few times, but not being able to close above there once at 4169, but then couldn't really move beyond it, and then the last couple of weeks struggled to close above that 4155 level. Of course, a lot of people point out the January high 4195, 4200 level coincides with this grey line, which is the 100-week moving average. That's at, where are we, 4200 now as well. So sort of big resistance zone around 4195, 4200 for the S&P 500 to move higher. A close, as I say, above 4155 would be constructive for then a push above there, but at the moment kind of struggling. We're tracking sideways really. You can see if we move to the daily, just pulling that back. Well, interesting trend line support. We have long-term trend line support acted as resistance, you can see, and then support in the last few weeks, sorry, We've backed off it a couple of times now, so interesting. If we do move down below 4,100 towards sort of 4,050, that coincides with the blue line, which is the 50-day moving average at 4,047. So potentially that's probably main initial support if we can't push above sort of 41.95, 4,200. So that's the S&P 500. As for the NASDAQ, sorry, just bear with me 1 second. Yeah, so the NASDAQ, just checking what you can see here, of course. If we just go to the weekly, you can see, well, it looks pretty constructive. We're tracking sideways, but we're tracking sideways above this late January high, 12,880. We still put it in there. You can see the dotted line. I'll move to the daily shortly and you can see it better there. We've got this sort of short-term trend line support as well. Probably comes in around that level if we do move lower to around 12,900, 12,880. So that's an important level for us. Tracking sideways did look like consolidation. So we're just sort of consolidating above that push higher, and then we'll move higher again. But we're sort of tracking sideways for quite a long time now, and we haven't been able to push above. You can see last week's high or the close was near the high, so that looked constructive, but then we've just sort of tracked sideways this week, and you can see here there's the 12,880 support line. We're holding above that. We dipped below it briefly towards the end of April, but then still remaining above it but tracking sideways. So if we do, the longer we track sideways, we should say, we always think the bigger range expansion will be eventually. So either if we can break this well, Monday high, probably 13,300 or so, then we'll push above and up towards potentially that 100-week moving average. That's at 13,439. You can see the grey line there potentially, and then up if we can push above then to the mid-August high, 13,720. If we don't, then obviously we've got that support line at 12,880. That's the NASDAQ 100. The Dow, pretty messy actually, to be honest. We've still got in here this massive, for us, resistance level at 34,281. You can see over the last few weeks, last few months even, haven't been able to decisively move above that. Tapped it a few times, couldn't move above it, couldn't close above it, and then recently again didn't get as close, but then rolled over. So just looking at the daily, you can see the trend line there, sort of sort of channel, and we've sort of just broken sideways really. Tapped the 50-day moving average. 100-day moving average is the grey one, so maybe first line of support at all of threes there, 33,333. Otherwise, then if we move lower, then 33,116 potential support. Otherwise, looking to push above sort of 34,000 up towards that big resistance level. Okay, that's equities. Let's quickly review then last week's main events. Let me just pull up a couple of charts for you. Firstly, hopefully you can see this one first. Eurozone inflation, of course, we had that out early last week. Surprise to the upside, came in at 7% year on year in April from 6.9% in March. Core inflation actually dropped marginally, 1/10 to 5.6%. From 5.7% in March. So you can see that on these lines here, the charts, the dark blue line, headline just ticking up slightly, core ticking off slightly, but still very sticky. Core really the one that ECB members, ECB officials look at a lot more, excludes volatile food and energy. So this headline is certainly coming down because of energy costs actually dropping sharply. But then it's more about the core reading for ECB officials. So the unexpected increase really is a result of a bounce back in energy price just over the last month or so, after the strong negative base effect in March and slightly higher service price inflation that we saw. But as with GDP growth as well, the previous week, inflation divergent divergence actually across the monetary union, across the Eurozone, is quite high, and that kind of reflects different energy, government energy price caps, subsidies, and pass-throughs from wholesale to retail energy prices. Looking ahead then for inflation, key metric developments in the Eurozone will be determined probably by two opposing forces, if you like. On the one hand, I kind of mentioned this, negative base effects on energy and food prices, so dragging the headline especially lower. And then on the other hand, still high selling price expectations in services, as well as wage increases. That's likely to fuel underlying inflationary pressures. So as I said, expect the headline to continue falling, but the core to remain sticky, and that is the ECB's problem. We saw that, of course, in the meeting last Thursday, widely expected. They stepped down to a 25 basis point rate hike pace from 50 basis points unveiled in March. That brought the deposit rate to 3.25%. Just want to show you this chart here. Certainly recent data confirm that underlying inflationary pressures still remain sticky. I've just showed you the chart really, especially the core. But then we've had this chart here is important, gained importance over the last few weeks with the banking crisis. And we've seen weak credit growth, and that's been seen in the latest results of this BLS survey. It's basically the bank lending survey in the Eurozone, and that indicated that the rate hikes so far are clearly leaving some stress on the financial sector of the economy. And you can see there we dipped down, loans dropping by the most since going back to sort of 08, 09. So definitely having a big effect, the rate hike tightening cycle. But for the ECB, well, forward guidance for more tightening didn't make it back to the statement. Of course, we have the statement first, and then a few minutes later, 3/4 of an hour later or so, we have President Lagarde's press conference. But initially, the statement, we didn't see any forward guidance for more tightening, so there was slightly a dovish feel to it. But then there was also this new emphasis on, in inverted commas, really forceful transmission of past rate increases, which kind of suggested the ECB was shifting to more of a wait and see mode. That said, of course, this was then balanced by a decision to end one of its bond buying programs, the APP reinvestments from July onwards, and that was kind of probably a concession in the statement to the hawks. But then we had the press conference by ECB President Lagarde, and she was kind of much more careful, much more forceful in a way to set the record straight. So if the statement contained no indication about future rate hikes, her press conference really was dotted with hints that more tightening was on the cards, subject to incoming data, of course, but she stressed that the bank has more ground to cover, is not pausing, as she emphasized really in the press conference, the inflation outlook continues to be too high for too long. I'll just bring up another chart here. So really she kept the door open for further rate hikes, and we can see on this chart, we've just, well, it's the FT actually, but they've compared the pink line being the Fed funds rates, going up to 5% there. You can see much more aggressive, and as well the Bank of England, than the ECB rate hike cycle. So potentially more work to do. That should have popped up actually to 3.25%. But you can just see the difference there and where the ECB stands with the other two major central banks anyway, the Fed and the Bank of England. Interesting, I think, as well. Yeah, so the door kept open for more rate hikes, and it was actually later revealed after the press conference. We always get this noise or ECB sources stories, if you're not aware of that, after the press conference, just trying to lay the ground, the hawks are doves, after the market reaction to the press conference and the statement. And it was revealed actually by one of these sources that there had been a deal actually done between the hawks and the doves on the Governing Council to go ahead with a 25 basis point hike only instead of 50 basis points, but then definitely reiterate this more hawkish bias towards more hikes going forward. If we just look at euro dollar, then just pull up the chart. Just bear with me 1 second. This is euro dollar. You can see if we just pull up the weekly. Decent run up, of course. Euro strength on the back of obviously ECB being more hawkish in the last few months anyway. Economy being very resilient, really, compared to obviously those dark days, especially if you remember in October, September, October last year. So decent run up, but now struggling sort of at that late January high, 110.32. That is that dotted line there, and you can see on the week again struggling to close above it. We've actually had last week, probably not the previous week, but last week we had a doji candle, so we opened and closed pretty much very similar level in between the middle part of the high and the low, and that was actually below that 110.32 level. So really interesting there, kind of indecision pointing. Doji points to really indecision between the buyers and sellers, and you can just see then if we just pull to the daily, tighten that up a bit, you can see that near-term trend line anyway, trend line support, which we sort of tapped a few times, just rolled over through that trend line support really yesterday. We're tapping now 109.42, which is the halfway point. Let me just pull that up. You can see there the halfway point of this decline from 2021 through to 2022. So the 50% mark of that decline is 109.42, and we're just sort of resting on there now. 109.56 we're trading at. So interesting whether that long-term sort of fib level acts as support. Otherwise, it looks like sort of this range bottom around where 109.09 is probably then next support, next strong support really, before potentially we roll over towards sort of 108.58. That's that 50-day moving average. Otherwise, upside potential, 110.32. We really need to close a weekly close above that to really then look at these highs, which look quite sort of tricky at the moment. That high at 110.95, of course, round number 111 to think about as resistance for euro dollar. Interesting as well, I should point out actually that the latest CFTC positioning data, so that's basically looks at big futures positioning, speculative funds, businesses, big businesses, all their positioning indicate the euro dollar is the most overbought pair in the G10. I think net long positions amount to 22% of open interest. That's the highest since early 2021. So always a decent sign to look out for. It's a very crowded trade, and any sort of turn could be quick if then the longs bail out pretty quickly. Okay, the other main event, of course, from last week, just pull up a couple of charts for you again, is, of course, the Fed. Just bear with me 1 second. Yeah, the Fed, of course, raised policy rates by those 25 basis points to 5 to 5.25% target range. Job market remains robust. We'll look at that NFP very quickly shortly. Unemployment low, inflation still elevated. We'll give that preview as well in a few minutes. At the same time, of course, the recent banking stress did result in tighter credit conditions, of which the impact remains uncertain. This kind of brought about a more neutral policy stance and guidance by the Fed. The committee no longer formally anticipates some additional policy firming, but it, of course, doesn't rule it out outright either. I think the committee said, or the statement said, that the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So in practice, what does it mean? Basically, the Fed at least temporarily produced a downshift in its forward guidance, but they kind of avoided pre-committing to a definite pause, really deferring to incoming data and obviously then being data dependent. That's really important because it just means we're set for more volatility, which is good for us, good for traders, because we're going from important data to important data. Big risk events then means more volatility, more potential for trading opportunities. Further out, Chair Powell, well, in the press conference, of course, he pushed back, as I've said, against the idea of rate cuts by the end of the year, referring to expectations of inflation, as I've also mentioned, declining only slowly. The markets think differently, as I've said, so they doubled down, really pricing in a bunch of rate cuts by the end of the year. I think it's probably worth looking at the DXY chart. It's kind of the opposite. If you flip it over to the opposite to euro dollar, DXY is obviously made up of 6 of the US's main trading partners. The euro is the biggest weight by far, around 56-57% or so in the DXY index. So that's why if you flip this chart the other way, then it will look a bit like the euro dollar chart. So that level of 110.32 is probably similar to 100.82 on the DXY. You can see there, so big support level. Tapped it a couple of times, and we're just sort of bobbing along there now. Any break of that, of course, then we're potentially then looking at, well, above there or tallying with that. You can see that 100-week moving average at par spot 85, so really reinforcing that support level. Otherwise then we kind of move potentially quite quickly down towards sort of 99, because we've been tracking sideways now for quite some time. Then, as I said, a range breakout will be potentially quite expansive and explosive. The base, there is a base though, and potentially then if we do push higher, we probably need to move above 102, and then probably this pivot high you can see from the start of May, the month to date high actually at 102.40, to sort of slow and stop this medium term or longer term downtrend that you can see from the highs back in autumn of last year. Okay, just quickly, just as well, let's recap. Sorry, just bear with me 1 second. We'll recap NFP, so non-farm payroll. Just get a graphic up for you with all the big numbers. Here you can see, yeah, the main numbers here. Still decent numbers in the April labour report. NFP rose. Here you can see 253k, 185 was consensus, but there was this net 149,000 of downward revisions to the past couple of months, spread evenly actually between February and March. Interesting then whether we get another revision of the 253. Also interesting, I think, that just this huge multiple number of months that we've seen NFP beat. I think it's every month except for one since the start of last year where we've had an NFP beat. What does that say about analyst estimates? That it's very tough, obviously, to estimate the headline number. Certainly since COVID, since the lockdowns, you've seen some massive big divergences between the headline and the estimates. I think 517 springs to mind, if you remember, 517,000 against a sort of 200,000 estimate or so, one of the biggest ever, I think. And just we've had, yeah, that continual beat in the headline. I think underestimated gains have been something like 1.7 million jobs since the start of last year. So just kind of something to bear in mind, whether this run can continue or eventually, I guess, analysts probably get it right and they have consistently underestimated, and potentially then that stops. But I can't tell you when that would be, and just like every other Wall Street analyst, I guess it is a very tough job in a way, but it just highlights to you how often that has taken place. Other main numbers, I think, from the jobs numbers report, really the big one was the higher than expected wage growth of plus 0.5% month on month against a 0.3% expected. That's this number here. Year on year rose 10th to 4.4 from 4.3. It all follows 3 straight 0.3 month on month prints. Probably really keeps some of the more hawkish Fed officials for sure quite nervous about inflation pressures, wage pressures coming in to the labour market. The household survey then, that showed a surprise decline actually in the jobless rate. That saw it tick down to 3.4% to match those cycle lows in January and then that multi-decade low from way back in 1969. All in then, kind of split views with the NFP report in a way, kind of leaves the Fed in a tough spot where they have to decide on either keeping rates at least at that current contractionary level for longer, or potentially then they deliver possibly another rate hike. Flip side, others say it's difficult to come up with a firm conclusion because really the labour market is a lagging indicator. Don't forget that. And we kind of tend to see somewhat contradictory signals at turning points. And certainly then I've pointed out some other indicators, but then the ISM survey certainly as well looking pretty ugly. And then we've had, of course, this the tightening of lending conditions, credit conditions, lending standards, credit conditions really tightening, and that always eventually results in unemployment moving higher as banks really, if you think about it, they're pulling credit lines, turning struggling businesses into potentially failing businesses, and then unemployment climbs. So that's probably something to bear in mind further out. 3.4 is obviously at multi-decade lows, but interesting that the Fed thinks that rises to around, I think, 4.5% through this year. Okay, let's quickly now move on to CPI, of course, the big report out in a couple of hours only now. This preview, just with the graphic, hope you like these graphics, the main numbers to look out for, what consensus expects. Probably big one, main one, 0.4% month on month in April, accelerating from 0.1% in March. That means the annual actually stays steady, actually around 5% year on year. Core is expected to rise at 0.3%, so that matches the previous month. Sorry, it's 1/10 lower than the previous month in March, 0.4% that was. And then that annual rate of core inflation seen unchanged at 5.6%. Just digging in the detail then, core goods inflation is expected to increase with higher used auto prices from the first quarter showing up in CPI this month, while inflation in other goods categories is expected to remain relatively flat. We then look at services inflation, that's expected to remain high. And if you remember shelter inflation, which forms around 25% of the CPI index, that's possibly going to show a slight decline in April, but is not expected to meaningfully drop, until later in the summer. And that's the key driver really for economists who are expecting this big drop in inflation potentially through the year, due to rent, shelter inflation coming down as house prices are already also deteriorating. So the housing market is deteriorating, and that will eventually drive rent down. That forms a big part of the CPI index, not so much say the Fed's preferred gauge, which is the PCE index. That doesn't have as much of a bigger weighting for rents and shelter as it does with CPI, 25%, as I say. So that potentially brings it down through the summer into the end of the year. That said, at the moment, 5%, that is, of course, more than double the Fed's target of 2%, uncomfortably high, really, for the Fed still after its most aggressive rate tight tightening cycle in, of course, living memory. 500 basis points we've seen now, but then we are coming off that high of 9.1% middle of last year, so sort of very gradual disinflation at the moment. Just checking out, we've done the dollar index. Yeah, what markets are looking at? Sorry, I was just checking that. Obviously, softer than expected data in this inflation data. That would confirm this sort of disinflation, this falling inflation bias, and potentially see the dollar test those year-to-date lows. 100.82 is a key number on DXY. 110.32 euro dollar, I guess. Flip side, of course, a strong report will potentially push up, of course, those rate hike bets, if you like. I think markets now assign around a 22% chance of a 25 basis point rate rise on June 14th, which is the next Fed meeting. Should also point out, whilst we're looking at CPI, that there is another CPI report the day before that Fed meeting on June 14. So we do have another CPI report to come ahead of the next Fed meeting. Okay, I think we'll probably look at Bank of England next. I should say, if you do have any questions, anything you want to look at, anything you want to go over again, please do ask a question. I think you can type them in the box, and we'll try to obviously answer those as best we can straight away for you. But hopefully this is proving useful. Just then moving on to the Bank of England, another graphic for you. We'll just look at cable to wrap this up, but just running through the numbers, expectations for the Bank of England to deliver a 25 basis point hike. That puts the base rate then at 4.5%. Just thinking about the prior meeting. The prior meeting in March, that saw a 7-2 vote in favour of a 25 basis point hike from two members, Tenreo and Dingra, and I think we're expecting that again, probably. The MPC opted to keep forward guidance on rates, which notes that if there were any evidence of more persistent pressures, further tightening would be required. Data since March really has leaned hawkish. I've put it in here really. The big issue, of course, is the year-on-year CPI print, still in double digits, 10.1%. Way above the MPC's forecast, and the core rate as well as 6.2% above the MPC projection of 5.8%. We also had strong wage growth, labour market headline earnings growing 6.6% above the 6.5% expected. So really all pointing to another hike, at least one more hike now. I think other data as well, just to point out, survey data showed an increase in the UK composite metric, fueled by really strong services sector. And then just thinking about what some of the MPC speakers have said, Bailey, he reminded markets that more tightening would be required again if signs of persistent inflationary pressures were evident. Interestingly, we did have as well, though, Chief Economist Hugh Pill. He mentioned that we have had or do have a lot of tightening already in the pipeline to come. So just a sort of contrasting view there. Focus then going forward or in the MPC will be on this forward guidance, whether they indicate the possibility of a pause possibly, or that they do have more work to do. The terminal rate, so that's the end rate for the Bank of England, seen around, I think, 4.85% the last time I looked. So that means another 25 basis point hike after this one, up to 4.75, and then the chances of another 25 basis point hike after that as well. Really interesting then to see what Bailey says. We do get actually the latest projections of growth and inflation. The risk really is there that the MPC raises the inflation forecast potentially, especially after this jump in Q1, that upside risk then would really help sterling move higher. Okay, let's just wrap up with a chart of the we've got a chart actually of headline inflation. You can see double digits, the lighter line there still in double digits, above 10%. Core as well, look, proving sticky. And then also I've got a sort of overlay of this chart done by Bloomberg. The pink line is where the benchmark BOE rate is, base rates really pushing up towards potentially 5%. That should probably be adjusted. 4.85 I think is the current level, and then you've still got this inflation level above 10%. Okay, just let's wrap it up with a quick look at cable. Just bear with me 1 second. I'll pull up the chart, which you can see here. So let's just go to the weekly, because we have this quite extraordinary, I haven't got it on here. Just bear with me 1 second. I just put up, doesn't help, but it sort of, just shows you how many consecutive weeks of games we've had. I think around 8, 9 would be this week if we had another week of 9 consecutive gains. Not kind of seen since around, I think, 2003. Not big moves, but just edging up nicely. After sort of tapping sort of 119.99, you can see is the 50-week moving average. So around that level, held the base there, and then have just edged up every week really with gains, and especially above that again, sort of late January high, which was the pivot point at 124.47. You can see we oscillated around there, sort of near term, kind of doji a few weeks ago in April, but then we pushed up above it, and we've held above it quite nicely. So upside levels, you can see the 100-week moving average at 127.08. 200-week moving average at 128.65. I think it's really interesting that a lot of, if you read some of the media, FT anyway, a lot of Wall Street analysts now sort of changing their tact, having been so gloomy about sterling, and now sort of turned completely the other way and sort of saying there is further upside to come. Interesting point of view, I think, when everybody turns, having been so negative on sterling, but certainly it's confounded a lot of people, this bullish run, due to obviously the Bank of England being more hawkish than expected, the economy staying and remaining more resilient, and then a few months back we had that Brexit agreement with Northern Ireland, with the EU, which really sort of took away any longer term risk premium, I guess, out of sterling. So technically then, finally, 124.47 key level for us as support. You can see we're just tracking sideways on the daily, still keeping above 126. Sort of round numbers probably key here, although that probably a nice area of support around 125.46. Otherwise 124.47 if we were to lose that. Push higher, and then round number of 127 and above, as I pointed out earlier, for cable. Okay, no questions that I can see. Hopefully you've enjoyed that. This webinar. We will be back in a few weeks' time for sure, and we'll be covering all the main risk events for you to hopefully which prove useful to you. I look forward to speaking to you then. Okay, take care out there.